Welcome back, guys. So, in this particular episode, what we will be doing is from SPR's exam kit, question number 35. Okay, so what we've been given is that you work for an accounting firm, you have asked to provide advice to clients about the following transaction. Okay, so Kite operates in shipping industry and owns vessels for transportation. In June 20x4, Kite acquired Shimon, whose assets were entirely investments in small companies. The small companies each owned and operated one or two shipping vessels. There were no employees in Shimon or the small companies. At the acquisition date, there were only limited activities related to managing the small companies, as most activities were outsourced. All the personnel in Simon were employed by a separate management company. The companies owning the vessels had an agreement with the management company concerning assistance with chartering, purchase, and sale of vessels and any technical management. The management company used a shipbroker to assist with some of this task. Okay. Kite argued that the vehicle was only passive investment and Simon did not own a business consisting of processes, since all activities regarding commercial and technical management were outsourced to the management company. As a result, Kite proposes to account for the investment in Simon as an asset acquisition, with the consideration paid and related transaction cost recognized as the acquisition price of the vessel. The directors of Kite require advice as to whether this is in accordance with IFRS standards. So input, processes, and output should be discussed. Okay. So this one is basically talking about business combination. So business combination and Simon, right? Okay. An entity should determine whether a transaction is a business combination by applying IFRS 3 business combination. That's right. So why am I doing it in bold? Okay. Once that's basically been laid out, so IFRS 3 defines business as an integrated set of activities and assets which is capable of being conducted and managed for the purpose of dividend return, dividends, or just lower cost. Or other economic benefits directly Investors hold other owners. Members or participants. Okay. So a business consists of inputs and processes applied to them. To those inputs which have the ability to create outputs. When analyzing the transaction, the following elements are relevant. Inputs being, so what are the inputs? Basically, investment in small companies, and the company owning the vessel had an agreement with the management company concerning chartering, purchase, charter arrangements, right? Okay. So inputs will be shares in vessels, vessel owning companies, small companies, charter agreements, charter arrangements, and then outsourcing arrangements with management company and something about that shipbroker management company used a shipbroker to assist with some of the talks, right? So relationship with a shipping broker. So what were the activities or processes? Processes being chartering, and then after that operating, financing, purchase, right? Okay. Activities regarding fitting the vessels and chartering. And then after that, financing. in the business. And then after that, what else will there be? Purchase and sell of vessels as well, right? And then outputs will be generate revenue from charter agreements and has the ability to gain economic benefit from the vessels, right? IFRS 3 states that whether a seller operated a set of assets and activities as a business or intends to operate as a business is not relevant in evaluating whether it is a business. Is not relevant, therefore that some activities were outsourced, as Simon choose to conduct and manage the integrated set of assets and activities. As a business. Accounting for the transaction as an asset acquisition does not comply with the requirements of IFRS 3 because the acquisition included all the elements that constitute a business. This would mean that the transaction cost should be expensed The vessels should be consolidated at fair value. The goodwill will be recognized or should be recognized. Should be recognized for the difference between consideration transferred and the fair value of assets at acquisition. Alright. So second question says that on September 1st, 2004, Bimbi, a listed bank, entered into a business combination with another listed bank, Lentil. The business combination has taken place in two stages, which were contingent upon each other. On 1st September 2004, Bimbi acquired 45% of the share capital and voting rights of Lentil for cash. On November 2004, so September, October, November, after 2 months, right? Lentil merged with Bimbi entered into a business combination with another bank, Lentil. Okay, so Lentil then merged with Bimbi, and Bimbi issued new A shares to Lentil shareholders for their 55% interest. Okay, then what happened? Then on August 2004, Bimbi had a market value of 70 million. So November, right? 31st November. August, September, okay. So Lentil had a market value of this. Business represents 45%. Bimbi's business represents 45% of total value of the combined business. After the transaction, the former shareholders of Bimbi, excluding those of the Lentils, owned 51%, and the former shareholders of Lentil owned 49% of the combined entity. The chief operating officer of Lentil is the biggest individual owner of the combined entity with a 25% interest. The purchase agreement provides for a board member of 6 directors for the combined entity, 5 of whom will form board of Bimbi, with 1 seat reserved for the former board member of Lentil. The BOD nominates the members of the management team. The management team comprises the CEO and 4 other members, 2 from Bimbi and 2 from Lentil. Under the term of the purchase agreement, COO of Lentil is the COO of combined entity. Bimbi proposes to identify Lentil as an acquirer in business combination, but requires advice as to whether this is correct. Okay. Bimbi and Lentil, right? FR 3 business combination requires an acquirer to be identified to be identified in all business communication. Acquirer is the combining entity which obtains control of the other combined entity. IFRS 10 consolidated financial statement says that an investor controls an investee when it is exposed or has rights to variable returns, variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. Right? Sometimes it is straightforward. Process power by looking at the voting rights gained when the parent acquires more than half of the voting rights entity. Normally has power the relevant activities the investee are directed by a vote. There is a presumption that an entity control or entity achieves control over another entity by acquiring more than one half of the voting rights. unless it can be demonstrated that such ownership does not constitute control. The guidance of IFRS 10 does not clearly indicate which of the mining entities is the acquirer, then indicators listed in IFRS 3 should be considered. The acquirer is usually the entity which transfers cash or other asset. In this case, as MB is the entity giving up cash amount corresponding to 45% of the purchase price, this represents a significant share of the total purchase consideration. When there is an exchange, equity interest in a business combination, the entity which issues the equity interest is normally the acquirer. Okay. In this case, as the majority purchase consideration is settled in equity instrument, Bimbi would appear lentil cellulite. So Bimbi would appear to be the acquirer. The acquirer is usually the combined entities whose shareholders retain or receive the largest portion of the voting rights in the combined entity. The shareholders of Bimbi the smaller the two combining entities appear to have obtained control since their share amounts to after the transaction, the former shareholders of Bimbi, excluding those of Lentil, owned 51 okay. Amounts to 51% of the voting rights. The transaction of controlling ownership, however, does not necessarily mean that the entity has power to govern the combined entity. Use financial and operating policies so as to obtain economic benefits from its activities, right? And what else does it say about the COO, right? It has 25%. Additionally, the acquirer would be deemed to be the entity whose owners have the ability to appoint or remove a majority of the members of governing body, the combined entity. 5 out of 6 members Bembirite are former board members of Bimbi, which again suggests that Bimbi is the acquirer. Additionally, the acquirer would be deemed the entity whose former management dominates the management of the combined entity. However, the management team consists of COO plus the management comprise of BOD's thingy, nominates the thing, and then 2, and then okay. So 2 from that, okay. So 2 from two former employees Lentil as compared to two former employees of Bimbi. Therefore, former management of Lentil has greater representation in case of management, okay. Although the board nominates the management team, COO will have significant influence through his share ownership and the selection of the team. IFRS 3 also says that the acquirer is often the larger entity as the fair value of Lentil, which is $90 million, is significantly greater than in the $70 million, right? This suggests Lentil as the acquirer. The arguments supporting Gimli or Lentil as the acquirer are finely balanced and therefore it is difficult to identify in this case can be argued that Bimbi can be identified as acquirer on the basis that Bimbi issued equity interest Bimbi is the entity transferring consideration and B has marginal controlling interest, that is 1%. Okay, so that's it pretty much, guys. So what I'll do is I'll cover the next thing in the other video. Okay, it's getting too long, so I'll do that. So if you have any confusions until now, please do comment down below. So this one was pretty hard, Bimbi and Lentil was. So yeah, I'll see you in the next video. Until then, bye bye.